Okay, hello everyone. My name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. So, firstly, I would like to thank all the participants who have taken the time out from their busy schedule and joined today. It's a very special day because I've invited Mr. Aman Chowhan from Abakkus. While there has been a lot of requests coming from a good number of investors that they wanted Aman to come and speak to us, but it has taken some amount of time because one, Aman was occupied with result season A, and B is obviously wanted to consolidate the outlook of the equity market. And there were a lot of things going on here and there. So we thought, why not we'll invite him at the appropriate time and then speak to him and read his mind. So I don't have to introduce Aman. Most of the investors who have already invested in Abacus are already there. I can see that, and numbers are increasing. Aman is MBA from Mumbai University and brings about more than 18 years of experience on the table when it comes to equity investing. And before joining Abacus, he used to work for Reliance Mutual Fund as a portfolio manager. He used to look after both domestic and offshore investing. He was based out of Singapore as well. And he has worked very closely with the founder of Abacus, Mr. Sunil Singhania. And it's like there's a saying in the market that they both work in sync so well that the output is always immense. So what we'll do is we'll read his mind and understand what sort of framework they follow at an organization level. Well, I can see there are a few new investors who have joined for the first time. For their understanding, let me just give you a little bit of introduction about Abacus. So Abacus is founded by Mr. Sunil Singhania, and he brings about more than 2.5 decades of experience. Before that, he used to work for Reliance Mutual Fund, which eventually became Nippon Mutual Fund, and he was the chief investment officer here. So as we speak today, Abacus has more than 3.5 years of track record on the table. And ever since they've started their AIF and PMS, they've sort of beating the benchmark significantly. So we thought performance is a secondary thing, but we'll understand today what sort of framework do they follow at an organization level and what's their approach to investing. But before that, Aman, thank you so much and welcome on the show of Ask the Expert. And thank you so much for accepting our request.
Sure. Great. Pleasure is mine, Vikas. Thanks for inviting me.
Yeah. So my first question is, which everybody wants to know, Aman, from you is that what is your house view when it comes to outlook of equity market at this point of time? We saw that post the Ukraine war, markets started falling down, and therefore we saw last week, we saw that markets have sort of bottomed out. Or what do you think? Is this bottomed out, or what's your views on the markets?
I feel it's a bit early to call it that it's bottomed out. Nevertheless, if it is bottomed out, it's very good. If not, then the bottom is near. It's not that its bottom is 20-30% lower than where we are. So we are at 16,500 levels. We bounced back from 15,000. We can go back to 15 in the next 1 to 2 months if the data points in US continue to disappoint, but not significantly lower than that. So if bottom is created, great. If not, we are closer to that. So I think investors should start looking at equity markets. Things should stabilize over the next 2 to 3 months. The dust should settle in US markets, both on the inflation front as well as on the outlook for growth front. Once that happens, closer to October, November, I think markets in India should start looking positive. The festive season will also be on at that point of time. And a combination of both good festive season and stable global macroeconomic should be a good combination for markets to start performing.
The result season and what all do you see some domestic concern, or it's only the international concern at this point of time?
Predominantly international concerns. I feel globally, including India, markets have already digested the interest rates and the inflation worries. We all know that inflation is high. Bond yields are already showing that the next rate hike is coming. So markets are prepared for the next rate hike. So that's no longer going to be a surprise. I think the worry today in the market is more to do with where the demand is headed. Because of the high inflation and high interest rates in US, there is going to be definitely impact on demand. So where the demand is headed is something that is what market grappling with. And that's where I think the concern is. The data point in US is something which comes very regularly, almost on a daily to a weekly basis. And the numbers there is what the market is now trying to fathom as to whether it's going to be a soft landing or a hard landing in US.
Yeah, the other
So
fear
in
in the
fact,
market.
because I have few slides with me,
Yeah, yeah,
which is
please.
highlighting the current market concern and what the current market outlook is, I can take you through the concerns as well as the outlook in detail.
Yeah,
Sure. So uh, is my screen visible?
yeah, very much.
Sure. Great. So, as we are discussing on the market outlook, I have a few slides detailing the current scenario and the outlook going ahead, and it will be I'll be happy to share the same with you. Fine. So, coming to the current sentiments, I feel post COVID, we had a dream run of almost 2 years where the markets have given phenomenal returns from the lows. And post that, for the past few months, volatility has come back to the markets. We are down almost 11-12% on an index level from the highs. Stock wise, you could be down anywhere from 10 to 30%. This is after the small bounce back that we have seen over the last week, 10 days. For the first time in after a long gap, mid and small caps have underperformed. So even in the March fall, when the Russia event happened, mid caps were holding on. May and June, we have seen mid caps underperforming the broader markets. What was hype and exuberance, both in the secondary as well as in the IPO market, is now got replaced by fears and concerns on both inflation and interest rates, which are now the most discussed topics as we speak. So this is where the sentiment or the background of the market lies. Why is this situation and what is going on? Uh, the current situation is this because this policymakers or the central banks, which infuse liquidity into the markets after the global financial crisis, after the Brexit event, after any major global event, and including COVID, today are reversing that. So they are hiking rates and they are reducing the amount of liquidity into the market in an effort to tackle inflation. So the abundant liquidity globally has led to inflation, and now the central banks are working hard towards addressing that inflation concern. We have seen the first round of rate hike already come in, which has come in sharper than what the initial estimates were. For example, initially we were expecting Fed to have a 25 pips rate hike over a 12 to 18-month period, which they have front loaded as we speak to a 75 pips rate hike in the last cycle. And in the next meeting, market is expecting anywhere from 50 to 75 pips of another rate hike. The Indian government also has put in certain restrictions on exports, steel, and other commodities, and some taxes to control the inflation locally here. The most talked about factor today is, as I was mentioning, what is going to be the demand destruction. So whether you call it recession, depression, stagflation, whichever word you use, ultimately, indirectly, what you're going to address is what is going to be the demand impact due to the high inflation and interest rate. And in my subsequent slides, I'll take you through what our view there is. Also, one of the recent big concerns has been the FI outflows that we have seen over the past 7-8 months. Never ever before historically we have seen such high FI outflows coming from the markets. And as we speak, commodities have corrected from the peak. So let's go through each one of the issues that we are facing right now. So while last 3 months have been brutal, it's also, I believe, more of a global event than a local event. Last 3 months, almost all markets except for the Chinese market have given negative returns, and India is also one of them. We are not the worst performing, or not even closer to the worst performing. Yeah, but we are also being at the receiving end. But at the same time, if you see an 1 year return, Indian market is still amongst the best. So Indian equity market along with the Singapore market would be among the best performing markets globally. And that is what I would want to highlight here, that yeah, last 2-3 months have been bad, but it's global, and over a 1 year period we are still amongst the best performing markets. So it's not of a doomsday scenario if somebody is so worried that what will next happen to India. I don't think so. We are in that bad a situation as if somebody is that worried. Uh, what has led to this correction? Markets have been brutal, especially in stocks where earnings growth have been delayed or is elusive. So if you see Nasdaq, the chart on your left is back to the pre-COVID levels. So all the COVID gains, the digital economy gains, the IPOs, the e-commerce, the new age economic companies, whatever name you use them, these new age companies, the digital beneficiary companies, at least from a stock market perspective, the prices are back to what it was pre-COVID. So all the COVID gains have got wiped off. Prices are down anywhere from 20 to 80% for these new age companies, and that has led to a big impact on sentiments both in US as well as globally, and the rub effect of that is visible even in India. And as I was mentioning, this time around, especially in the last 3 4 months, mid caps, after a good 2 years of strong outperformance, have underperformed the broader Nifty. So the current concerns are obviously inflation and interest rates, and we all know that the CPI interest rate in India is high double digits. The consumer interest inflation is close to 7 to 8%, and the printed inflation in US has hit a high of 9%, which is will be the highest amongst a few decades, and that's what the real worry is. The good thing is that the bond yields have already started to discount the rate hikes with the Fed and the RBI is going to do. So you see the 6% GSEC in India has already moved to 7.5%, and the 0.5 to 0.8% US GSEC is already touching 3. So looks like the bond markets have already discounted or already priced in the inflation and the interest rate hikes that the market seems to be worried about. The other concern which the markets have was the high commodities prices, which indirectly have led to the inflation number that we have seen. Even here, the recent updates of the recent few months data points suggest that almost all commodities are off their peaks. They are down anywhere from 10 to 30% from the recent hikes. And not just the commodities, even agri commodities have corrected decently from the recent highs. So that's what the situation is. And hence, my take on inflation is that the worst of inflation is already behind us. On numbers, it will be start getting visible in the next 2 to 3 months, because the benefit of this lower commodity prices will be visible over that time frame. So it doesn't happen overnight, both on when it's moving up or it's moving down, and hence I think it will take 2 to 3 months for the lower inflation numbers to start getting reflected in our in the numbers that both India as well as US report. So beside inflation and interest rates, the other worries would be the geopolitical issues. The Russia event is still ongoing. I don't expect any incremental news coming from there. In fact, there's a very high possibility that there can be positive news, either of a ceasefire, either of Russia declaring a victory and closing down the ground level skirmish that it has going on, and things can get better on from here rather than getting worse. But nevertheless, it's a situation which is fluid. One needs to constantly monitor the situation. My optimism stems from the fact that embassies in Kyiv in Ukraine have started to reopen. Both the US as well as India has reopened the embassies, which means that the war situation is limited either to the border areas or the disputed areas between Ukraine and Russia. And it is no longer that Russia wants to completely invade Ukraine as we speak. Oil prices is something which has been a big event for India. It's one of our largest import bills. Oil is hovering close to $100. Our view is that oil is headed towards 75 rather than going to 150. But if somebody has that fear that oil can go to that levels, my optimism that oil should head to 75 comes from the fact that one, shale gas production is rising. Second, if oil stays at this level, it's only Middle East that benefits, nobody else, and hence the current sanctions that one has on Iraq, Iran would come off, and hence supply can materially rise from these regions. In spite of whatever economic sanctions Russia is facing, it is still physically exporting oil in at a discounted rate, and India is a big beneficiary of that discounted Russian oil, and hence the demand supply in the market is getting met. It's just that prices have yet to correct, which I feel eventually should head it back to 75 levels. If this happens, it's going to be incremental positive both for the economy and for the equity markets. Uh, INR depreciation is also one of the talked about points. Rupee has just hit 80. If you look the past and also the current rupee move, you'll notice that the current move to 80 is more of a function of dollar appreciating than INR depreciating. In the INR has in fact appreciated versus most other currencies, whether it is yen or pound or euro, and it's among the best performing currencies. So the move to 80 is more of a dollar appreciation move than anything going wrong with INR as a currency or India as a country, and hence I'm not too worried about the recent INR move. Now coming to the situation in India, two or three key positives that I would like to highlight here is that one, post the lockup opening up trade, the revenue growth in India and the demand has been pretty robust. There have been only some pockets where the demand has got impacted due to the high inflation or due to high prices, but nevertheless, for say 8 out of 10 products, the demand continues to remain robust. Uh, there is margin pressure definitely across companies, across sectors, because if you look around the input prices, any input price, if you're running a business, you will notice that whether it's steel, cement, copper, freight, power, manpower, anything and everything has gone up. And not every company will be able to pass it on. And whoever is able to pass it on is also indirectly leading to contributing toward the inflation numbers. So this margin pressure is here to stay. We're already seeing 2 quarters of this margin pressure. I feel another 2 quarters, and then the margin pressure should subside. One, because the base effect, and also as we have discussed, the commodity prices are already off their peaks. So the benefits of that will start reflecting in a quarter's time, and that is going to be something which is positive. India continues to be among the fastest growing economy. That's something is great for global investors to look at. The government seems to be doing fine. The fiscal deficit targets are on track. Investment targets would be slightly off, but nevertheless, government has bitten the bullet, gone ahead with the LIC IPO to show the intent that they mean business and they would want to walk the talk, and which is a very positive sentiment message that they have sent across to global investors. And this is something which we are pretty excited about. Also, we are seeing a big shift happening from unorganized to the organized sector, and that is getting reflected from the GST revenue collection and the direct tax collection, which are rising month on month and are, as we speak, closer to the highs. The chart here is reflecting that the GST collection as well as the direct tax collection, plus the IIP growth also has started to pick up. Uh, Also, what is helping India and indirectly what is helping the currency is in the strong forex reserves. So we have almost $600 billion of forex reserves, which is historic high, closer to the historic high number. And this is something which we never had ever before in the post independence. And at the same time, the worry that people have on oil import bill, what has happened is over the past few years, the IT export demand has been so strong and the IT sector has been growing steadily that today the oil import bill and the export receipts of IT services that the country gets is almost matching. So hence IT is able to foot the bill of oil, and this has led to a very good positive impact on the current account deficit. And hence overall as an economic point, India is quite well placed. The rural economy also seems to be doing well. Monsoon had a late start, but now it's picked up. We have seen decent progress pan India on the monsoon front. Agri commodity prices are high. That is leading to good farm income. We are also seeing good amount of export coming in for the agri commodities. Plus, the government focus on the rural economy stays, and hence we are seeing that the rural economy is pretty well placed in the current cycle. Uh, Proactive steps by the government, whether it is Make in India, the PLI schemes, the focus on defense, the Atmanirbhar Bharat, the multiple things that the government has taken initiatives seems to be working. We are seeing good amount of capex getting announced for setting up manufacturing plants under the PLI scheme. We have one of the best corporate rates across the peer group countries, and that is something which is also very attractive for somebody to come in and set up a manufacturing unit or a business unit in India. Uh, Make in India program is successful. Government has been able to uh, reduce the defense import bill significantly as we speak, and that trend is going to continue for a long time. And the focus for the government is pretty clear, and hence we feel that we are in very safe hands as far as the government actions are concerned. If COVID wouldn't have happened, things today would have been much better than what it is today. Nevertheless, the government has handled the medical emergency pretty well, and it's well equipped to handle the economic situation also. So that's broadly on the economy, where I feel that we are very well placed. The demand concern which globally people have, I feel is not going to be much of a concern in India, for a simple reason that, say for example, US markets. In the US, the mortgage rates of the housing loan come at 2%. Because of the recent rate hike, it has become 4%. So if somebody's earnings at $10,000 in US and his EMI was $2,000, his EMI is doubled to 4,000, and that definitely is going to create an impact on his lifestyle, on the way he spends. But in India, the housing rate itself used to be 7%, which is going to 8%. A 1% move here and there, it's not going to change your decision, or it's not going to change the demand environment drastically. So my take is that the demand is a bigger worry in the US and in the Western world than in India. Here, domestic demand should remain stable. At the same time, the export growth outlook that we are seeing is pretty high because of China plus one strategy. Lots of new sectors, lots of new economies have opened up. We have now sectors like textiles, garmenting, tiles, even electronics that we have started to export, which earlier we used to import. So that is something which is a very big macro tailwind Indian corporates are facing. Hence, we are gaining market share in the global trade. So keeping all these things in mind, I feel the demand environment in India should stay stable. And if that is the scenario, then once dust settles in the US markets, India will be in a sweet spot and should do well. Coming specifically to equity markets, post the recent corrections, where do we stand? Uh, on a PE basis, we are now close to 18 times 1 year forward, or, which is below 10-year average. And we feel it's a decent number. It's not something where the market is very cheap, but at the same time, it is below fair value or closer to the fair value. So it's definitely not expensive the way it was, say, a year back. At the current 17, 18 times, we feel the risk reward equation is in favor of investing rather than getting scared. Uh, Also, one needs to realize that the old historic PE ratio of India needs to be upgraded, because when India used to trade at 12, 13, 14, 15 times PE, that time the bond market or the repo rate or the FD yields used to be 8 to 9%. Today they're closer to 5 to 6%. So the bond market or the debt yields have compressed, which indirectly means that the equity valuation should go up. So the old range of 12 to 15%, 15 XP should now move from 15 to 20 XP, and that is where we are at 17, 18 times. We're absolutely within that range, and hence I'm not overly worried, at least as far as the valuation is concerned. We have decent ROEs as a corporate India, which justifies the valuations that market is trading at. Till the time corporate earnings are strong, markets should do well. That's what the broad thesis is, because ultimately markets are a slave of earnings. Here we feel that the mid-teens to high-teen kind of corporate earnings should sustain, and one of the big factors helping this would be the shift from unorganized to organized. So stock market gets represented only by the formal economy of India, the large corporate India, which are in the formal segment. The informal parallel cash economy of India is not represented with the stock market. So as this informal economy loses market share, which is gained by the formal economy, the corporate profit growth for formal economy is going to go up, and ultimately this is what stock markets look at, and that the trend is going to be good, which means that markets are in safe hands, or there are enough earnings triggers for the markets to deliver returns. Keeping this in mind, I feel that equity returns from India can be decently strong. Coming to the FIs, we have seen decent amount of selling, almost $50 billion of outflow in the past several months is what we have seen. While the number is right, but it is not the complete picture. What we see is just the secondary market sales. What we don't see is the primary market inflow that we have seen, or the IPO inflow. So, as per the data that we get after this $50 billion which has gone out, almost half of that, or $25 billion, has come back to India in the IPO market. So we had large IPOs of LIC, Nika, Paytms as they were, and this and many others. And FIs have invested in most of these IPOs. So 50 has gone, out of which 25 has anyway come back in the IPO market. At the same time, we have received more than $80 billion on the FDI front, which is a historic record high number that we have seen. So earlier, this trend used to be that India used to receive both FII and FDI money. So both left and right hand used to get money. This time around, in the last 6, 7, 8 months, one hand has sold, but the other hand continues to buy. If you net it off, we are still positive. 80 of FDI, 25 of pre-IPO money, primary market money, minus 50 of FI money. We are still $50 billion plus. So while it's concerning that FIs have sold a lot, whatever our interaction with them is that it's not a situation where they have a negative view on the country or on the economy. It's more to do with what the clients eventually wants. Because ultimately, what is FI money? FI money is also public money at large. The way we have retail investors or HNI investors which are investing into mutual funds in India, the same way we have retail and corporates of US who invest into an emerging market fund, that emerging market funds invest into India. Tomorrow, if those guys or the investors are deleveraging, they want to book profit, they want to do something else, or because of inflation, they want more of surplus cash to spend, they are going to send redemption request on FI, which has no choice but to sell and give the money back. So the FI selling is not a reflection of what their view on the economy is. It's not that they know something which we don't know. It's more of a technical function. It's more of a liquidity function that we are seeing these outflows. Over the next 3, 4 months, once the dust settles, I feel FI inflows should resume back to India for two reasons. One, as the economy we continue to do well. Second, and more importantly, the peer group has become very weak. If you look around, Sri Lanka is already bust. Pakistan is in bad shape. Bangladesh is also not doing that great. Investors don't want to go significantly overweight in China after having lost money due to government intervention in the likes of tech companies like Alibaba, Tencent, and others. Uh, I was reading article which was saying that Turkey is facing almost 70% inflation, as the Greece, Portugal markets are also not doing that great. One or two African markets are also facing the risk of a sovereign downgrade. You don't want to invest into Russia now or closer to Russia and Ukraine or any other market. So the competitive landscape or the peer group of India is in a significantly weaker position than what it was, say, 2 years back or 3 years back. So once the FI starts to reinvest or to look at emerging markets, then they have a handful of choice. Maybe a Philippines or a Malaysia or a Thailand market is doing well. Along with that, we have India. But compared to the size, the opportunity, the under penetration that India has, and the good ROEs in corporate India has, India is far better than any of the peer group. And hence, I'm 100% convinced that once FI money starts to relook to get invested, it's natural that it is come to India, and India will get its fair share and also improve on its market share. So yeah, the next few months can be volatile because of the FI inflows and outflows coming in and out. But if you take a slightly longer time frame, I'm pretty confident that the FI money should resume back in India. If the Indian equities also have performed well versus what others are. If you take a 3 year period or if you take a 5 year period, we would be among the best performing markets across the region. And FIs have made money here. It is not that they have lost money, and hence as I was mentioning, I'm pretty confident that they'll come back. Coming to what the market outlook would be, that chart on your screen is showing the last 3 decades of negative returns in Indian equity markets. If you look around, the last 6, 7 events that Indian equity markets have given negative return has all been because of global factors. We had 2 to 3 years of negative return post the dot-com bubble, then we had the housing crisis of US, then we had the Brexit, Eurozone crisis, the Greece default, and then the COVID of FY20. These are the years when equity markets have given negative return, and all the reasons have been global. This year could be a flattish to a marginally negative year also, and also again it will be global factors because India as an economy continues to do well, and as history suggests, this has been a good opportunity for investors to increase their equity exposure, for investors who have not been exposed to equity markets to take advantage of the current correction of the volatility and come in with a 3 to 4 year view. Till the time economy does well, I feel one should ignore the near-term volatility and stay focused because India seems to be in a quite healthy and a good shape. So in this backdrop, we're now coming to the portfolio and what have been our stance and what have been we doing. For the last 6 to 8 months, we have been highlighting in our monthly newsletters and all our media and public interactions that the risk to the market is that of margin reset, the margin issue, which also indirectly means that it's inflation. So we were preparing the portfolio. We were preparing the portfolio positioning to tackle this near-term situation, and hence there has not been a major shift in our portfolio stance. Our focus on fundamental investing stays. In the current scenario, we find maximum value in financials, followed by IT. IT is something that we used to have a fairly large overhead position. Today, I would say that we are neutral on IT. The market seems to be neutral to negative, but we are more positive than I'd say the consensus view on IT is because we feel that even if there's a recession in US, what ultimately is going to happen is that the companies there are going to cut costs, and hence there is no better way to cut costs than by giving more business offshore to INSEE or TCS than giving that same business to an Accenture at 4x the rate. We are also pretty excited on the rural economy. As I was explaining, the rural demand is quite strong, and any company facing the small town or the rural segment of the economy is doing well. While prices have corrected, and so have been our portfolios also, today the portfolios trade at 11 to 12 times FY24 earnings, which is a very healthy valuation number because the market is trading at a premium to my portfolio. And from here on, even on an absolute basis, a 10 to 12 P for a 15% plus earnings growth for the portfolio, the risk reward equation seems to be quite in favor for an investor. We expect, like post-COVID, when COVID market hit us, markets were down, our portfolios took a beating. The same thing has happened in the last 2 months. The portfolio has taken a beating along the markets, but we are pretty confident that the current portfolio that we have will stand the test of time. When markets starts to recover or move up, we'll regain the alpha that we have been consistently delivering. So net, in conclusion, our take is that be positive. In the past and in the current situation also, it's been more of global events that has impacted Indian equities, and it's a chance for local investors, for domestic investors to come in and take advantage of this volatility. We expect Indian equities to continue to deliver mid-teens to high-teens kind of returns. Returns won't be linear. There can be years when the markets are flat or even negative, but the subsequent years the market deliver 30-40% return, and on an average a mid-teen to high-teen return is very much possible, because this is what eventually what we are expecting as earnings growth to come in also. So what we are expecting is that markets will at least deliver what the earnings growth in India would be. The economic outlook is robust. Domestic demand is strong. We have capex going on. We have new sectors contributing due to China plus one. We have seen the formal economy gaining market share. On the macro front, reserves are great. Rupee is stable. Our CAT situation, in spite of a higher oil price, is under control. And from here on, looks like bulk of the negative news is in the price or already getting factored in. The coming few months can be volatile because the data frequency in US is pretty high, and in the near term, those data can disappoint. And hence, if somebody is looking at uh, deploying capital in the equity markets, our suggestion would be stagger it over the next 3 to 4 months. So if you wanted to deploy say 100, put 20 right away. The balance 80 can come over the next 4 months. We suggest a 3 to 4 month staggering rather than a 12 to 24 month staggering, because we expect once the inflation numbers cool off, once dust settles in US markets, India will continue to grow, and that would eventually get reflected into the equity market returns. So that's broadly from my side, both on the markets, the portfolio stance that we have. I'm sure you guys will be having some queries. I will be happy to address any
Yeah,
of them.
we'll come to that. Yeah, thank you, Aman. It was a great presentation. We got a lot of insights today. So what I'll do is I'll request our participants to write down their questions in chat box. While they're typing in, the question is so Aman, there are few investors who are looking at investing in our fund for the first time. So for their benefit, if you can talk to us about what sort of philosophy that you follow at an organization level when you are investing across the strategies that you manage. Over to
Sure.
you.
Good. Um, Fine. So if somebody is looking for at us for the first time, this is a broad philosophy which is there on your screen that we follow. This is what differentiates us from our peers. This is what different that we do. The first foremost thing that we follow is that we don't do benchmark investing. So there will be very few funds who don't look at benchmark, and we will be one of them. So there is no concept of underweight or overweight in my office. The view that we follow is pretty simple. That if we like a company, we'll invest in it. If we don't like, we won't invest in it, irrespective of whatever weight the index is. And hence, there is no discussion of whether we be underweight or overweight. The discussion is only should we invest or shouldn't we, and it's as simple as that across the three buckets of the market, which are large, mid, and small caps. We do only fundamental investing, no technicals, no derivatives, no quant models, nothing else. Neither me, neither any of our team members do any of these things besides fundamental bottom up stock picking. If you look around to my portfolio, almost 30-35% of my portfolio is stocks where I'm the first or the only institutional investor. Which what this indirectly means is that we generate our own ideas, and we are not shy to execute them once we have a good idea. There are many people who would feel that no, I don't want to be the first one, or I would like to be investor only if somebody else is also there. Not for us. We are more than happy to be the first one because that gives a good first move advantage. Uh, we are patient investors. We invest with a 3 to 4 year investment horizon, with a broad view that the money should double during this period, which can come from a combination of both earnings growth as well as valuation re-rating. We are agile, flexible, portfolio is monitored on a daily basis. If the investment call or thesis is not working, I would bite the bullet, book a loss, get out of the stock, and move that cash somewhere else, rather than sitting in the same stock with the hope that the next year or the next few quarters would be better. And finally, one of the biggest views or one of the biggest philosophy that we follow is that for any investment that I do, the risk reward equation has to be favorable. This is something that I very religiously follow. It's a discipline that we have embedded into ourselves. And what do I mean by this risk reward equation? It means that while we are not a value investor, that I'll not just go ahead and buy a cheap stock just because it's at a 5p or a 6p or whatever the number is. But definitely, I'm a value conscious investor. By this, what I mean is that I do mind paying a significant premium just because you're the market leader or you're a great company or the market favorite. If you're going by 10, 20, 30%, I don't mind paying a 20, 30p. But I definitely do mind paying a 70, 80p for a company which is growing at 15%. And that is what my view comes in. For me, a great company or a good company also has to be a good investment. Ultimately, I'm running a financial product, I'm running a fund. My clients are looking for a financial return. They are not, I'm not the promoter, I'm not the owner of the business. For me, financial return matters most, and hence the risk reward equation has to be favorable. A great company will be a great investment only if you buy it at the right price. And that is what we very religiously follow. And hence, practically speaking, you will not find very expensive stocks in your portfolio. So we are shy to pay abnormal premium. More or less, you will find the portfolio having a good balance between earnings growth as well as the P, which I explained that the current P of both the strategies that I follow would be 11 to 12 times FY24 earnings. So that's the key philosophy that we follow. And uh, to help us follow this philosophy, we have a simple framework which we call as the MEETS framework. These are the points, or these are the check boxes that we consider before any investing. Within the MEETS, M stands for management, the management quality. Management is the captain of the ship. It is the most important factor that we look forward, because it will he who will determine where the ship is headed and at what speed it is headed. And hence, the background of the management, the past track record, the current meetings, we have not invested into a single stock without meeting the management. Each and every portfolio company that we have interacted with the management. We know what their goals are. We know what they intend to do and how it fits into our investment framework. Without the management meeting, I have not, and I would never be investing into any stock. Uh, the E in MEET stands for earnings. As I mentioned, earnings growth is very critical and very important for us. We have this very firm belief that only value doesn't work if there is no trigger along with it, or there is no earnings growth along with it. If the will become deep value, but if the value gets combined with an earnings growth, then I see a good scope of alpha and a good scope of re-rating happening in, and that is what I always look for. And hence, in my portfolio, I have a very strong focus towards earnings growth. The other E stand for events or trends. There are certain events in the markets or in the journey of a corporate, and we very closely monitor that. It could be events like, say, an M&A or a divestment or a stock split, or say change of management or change of some policy regulations, which can have a positive impact on the outlook for the corporate. And that is something that we are pretty excited about, and we very closely monitor it. T here stands for timing. Timing is clearly not market timing. That is something that I can't do. I don't even attempt doing that. For me, timing is more to do with timing of the corporate earnings cycle. As a company, we all have our ups and downs. There are a few years when things are good, there are a few years when things are not so good for various reasons. We would obviously like to time where the growth is. If the growth is accelerating, I would definitely be investing to that company. If the growth is decelerating, then I would tend to avoid it. Or if the growth is expected to pick up after 1, 2, or 3 years, I would tend to buy it closer to the turnaround rather than buying right away and sitting for the next 2 to 3 years with zero return. So that my timing is predominantly where the earnings cycle is headed. And the last S in the MEETS framework stands for the structural opportunities. A growing economy like India with a high level of under penetration offers lots of structural growth opportunities, and we obviously would also like to benefit from it by investing to such companies with a portfolio. So broadly, this is the framework that we follow for our investment across both the strategies that we follow.
All right, so a couple of questions. We'll take them quickly. We are running
Sure.
short of time, so only 10 minutes are left out. So first question is from Mr. Bhatia. He's asking if PMS horizon is for 10 years, is it feasible to invest in mid and small cap PMS instead of all cap? So I'll answer that. Yeah, you can invest in mid and small cap. The second question is if the valuation is attractive and corporate earnings growth also they are as per the expectation, then why markets are not bottoming out when market will move up? Over to you.
See, there are two things in the market. One is corporate earnings, the other thing is liquidity, or you can say sentiments. Infosys or TCS or HDFC Bank as a company or as a corporate is the same. But the stock price of Infosys changes on a daily basis, on every minute basis. The company is not changing. It's the same Infosys 5 years back, 1 year back, 1 month back. Yeah, obviously the level of profits have changed, but the company is the same. But the profits are not changed on a daily basis, but the price does change. So in the near term, what determines the price movement is a combination of sentiments, liquidity, technical factors. If somebody is coming in with a 3 to 4 year view, if somebody is a fundamental investor, then these are near-term noises one needs to ignore. Your query is to if corporate growth is good, and if things are fine, why the market's not bottoming out? The markets are not bottoming out because of the liquidity overhang that we are facing from the global markets. The global markets are volatile because of the demand concern that they have, and that is having a rub effect on Indian sentiments also. We need to factor in one very important point is that FIs in India own almost 25% of the market cap. 50% of the market cap is government of India and promoters. So effectively, FIs own half of the float of Indian equities. That's a substantially high number. Anything that goes wrong in the markets, anything that goes wrong in the house is going to have a liquidity impact on Indian equities also. So while we can continue to grow, we can continue to do well both on an economic as well as on the earnings front. Because of this technical liquidity overhang or the sentiment overhang, in the near term, markets may volatile or may undershoot the fair value. But eventually, if we are doing well, as all things which revert to mean, Indian equities also will deliver strong, decent mid-teens to high-teens kind of return, which they have been doing consistently over the past several years.
Yeah, next question is from Mr. Thole. I think I can see that he's asking some specific question with regards to specific stocks. So I just want to highlight here one disclaimer that we are not going to discuss any stock specific area. Keeping in mind that if you have any query, you can discuss with your advisor and invest. But if you, when you are giving the mandate to the portfolio manager, then I think you should give complete mandate and let the portfolio manager to decide when to increase or reduce the weightages of the stock. Next question is from Mr. Bhatia again. So what sort of returns that one can expect if they are investing in emerging opportunity fund in the long 10 years time frame? I don't know.
So,
Aman, would you like to take this question?
yeah, so I think if somebody has an investment view of 5 to 10 years, then mid-teen to high-teen kind of returns is very much possible from Indian equities.
Okay. The next question is that so what is the expectation from the Fed stance that they're going to announce on 27th of July?
There's going to be a rate hike anywhere between 50 to 75 bips. More important is what the Fed says in its outlook than the action, because this action is already known or fairly well understood and discounted by the markets. So the outlook is what matters. I expect the Fed to give an outlook that it's going to keep a very watchful eye on the demand scenario in in US. If it feels that demand is weakening more than its comfort zone, then Fed will take necessary action to address that. So that's the outlook I expect Fed to give, which I believe the market should take it positively.
All right. So with that, we would like to conclude the session here. Aman, thank you so much for taking the time out from your busy schedule and you joined us today and interacted with all our investors. And I also take this opportunity to thank our friend Archan for helping us to put up this beautiful show. So thank you so much.
Sure, great. Thanks for inviting us. And any queries or anything on our funds portfolios, feel free to get in touch with my team, and they should be happy to help.
All right. Thank
Yeah.
you.
Thanks. Thank you. Thanks, Vikas.
Thanks, everyone. Yeah. Bye.